Hi everyone, this is Rob Roy and welcome to the Elliott Wave Elite U.S. Market Update. Taking a look at the charts, we can see that the S&P at first blush appears to maybe be consolidating a bit. And if you put the Elliott Wave count on there, you would be in the ABC corrective patterns. But remember, not all corrective patterns are sideways consolidations. The zigzag pattern is a directional pattern. Now, if you're frustrated at all by, I'm not, because I like trading the corrective patterns. In fact, Rick Santelli was talking about Elliott Wave. He's one of the guys that there's not very many of the market pundits on the financial networks that I respect. He's one of them. He talks about the bonds on CNBC, and he was talking about not just Elliott Wave patterns, but the corrective patterns. And I haven't heard too many people talk about the corrective patterns, so I found that fascinating. But if that bothers you, one thing I wanted to show you is you could come over here where it says daily and go down and change the count to weekly. That's a smart thing to do because Elliott himself has always said to always take a look or keep in mind the bigger picture. Look at the next longest time frame to make sure that that confirms what you're seeing when you go to put on a position. So if we change the count from daily to weekly, we are in a wave 5 pattern to the upside. And isn't it fascinating how the market was marching up that 45-degree line to the wave 5? That line is not designed to follow the market. The market in this case was following that line before we went into this corrective mode. So according to this pattern, we don't take out that wave 4 low. We will stay in the wave 5 to the upside, and sometime at the beginning of next year, we will reach that new high. That's really not out of the realm of possibility, even if we correct more at this point in time. So we go back to the daily chart, because I do want to look at what's going on at this point now and take those off. Remember last week we talked about how we had this complex A wave to the downside, very classic zigzag pattern down, and then we had the bounce right to the 61.8% level with a doji right on that level. So that was our bounce up to a mono wave B. So we had a complex A, a mono wave B, and then that would set ourselves up for, at least it's qualified at this point, for a wave C lower. Now where would that target be if we use the fib extensions to see where the 100% extension would be? That's the extension when you're looking at a 61.8% correction, is right down there in the neighborhood of 2470, and we did send out a put debit spread case study to our subscribers on the SPY at the end of last week, actually on Friday. And the reason for that is the pattern is qualified. Now, we talk about the butterflies a lot to the upside because the butterflies, especially an out-of-the-money butterfly, is very low risk, high potential return. I don't necessarily use the out-of-the-money butterflies on the way down because things can move down so quickly. And when it moves down so fast, you can either overshoot the mark because of the fear factor that plays in, or butterflies don't necessarily work quite as well if you get there within a day or two. So on the upside, then things tend to take longer to reach the target. To the downside, a little quicker. So the out-of-the-money butterflies make great sense to the upside. On the downside, I tend to like to use straight puts or put debit spread. That's what we did in this case. Now, one could make an argument if we go over here and look at a chart of the SPY that we are consolidating in the market and not necessarily getting ready to head down, because you could say we have the same highs here, and then on the lows we have a set of higher lows, and we are forming an ascending triangle that's getting ready to break out. Not a bad argument to make, but one of the things that bothers me with that argument is that you go look at volume, pardon me, and in the volume standpoint here, you can see that we are above average. That's not normally what happens. We've talked about this before, that normally when you are consolidating, volume goes down. Well, you could also say, well, wait a minute, the volume on these highs has been moving lower. So we have these pardon me, lower highs on the volume on the way to the downside. It's still above average, though, and that's not normally what happens in the consolidating triangles. Now, if we consolidate more to the upside here, we could break to the upside. That would follow more with the seasonal trends. But when you have a qualified zigzag, especially with a 61.8% B-wave correction, I tend to follow those. Taking a look at the VIX, we did have a move down on Friday to the downside, but remember, with the Elliott wave pattern, we have disqualified the upward pattern, but volatility remains elevated, and as an option trader, that's all you want. You just want elevated volatility, and that keeps things moving quickly, and that's when we can make money on a very short-term basis. Looking at TBT for interest rates, which was one of our triangles. Remember, we talked about having a false breakout to the upside because there was never a qualification day. One thing that I wanted to bring to your attention here is we have broken below the midpoint. It's not unusual at all to have a breakout that's not confirmed, then you come down, test the breakout point, and then turn and head back higher in the same direction. You don't usually break that midpoint, though, and we have, which would lead us to believe that there is the possibility, pardon me on the voice, to continue lower from here, and that would play right in the hands of this downward zigzag pattern in the marketplace in general. All of this argues against the seasonality of the fact that the market tends to drift higher at this time of year, but for me personally, I would much rather trust the Elliott wave pattern rather than seasonal trends. I know people do believe in the seasonal trends. I'm just saying, for me, I would let Elliott wave trump that. No pun intended with our president. Looking at our current case studies with MasterCard, we are still staying in that wave 5 pattern to the upside. We are consolidating a little bit. We had a doji on Friday. We'll see how that plays out on Monday's trade, whether we break one way or the other here. But there's nothing in this pattern. In fact, having a consolidating triangle in the wave 5 just simply means that it's a complex wave 5. So that's not unusual by any way, shape, or form. So that stays in place. Remember, another one of the great things about using now the money butterflies is time decay works in your favor. Now, we did look at a potential case study that came out on the bullish side out of PLCE. However, we have broken below on Friday my lowest level, which is a 61.8% correction. So we exited this one on Friday. Again, butterflies, very low risk, high potential return. Take a small risk, take a small loss when you're wrong, and then you have the potential to generate great profits on the way up. And taking a lot of losses and still making money is a really good way to be profitable over the long haul. If you've been watching these recordings over the past year, you know we haven't been wrong that often, but it's nice to know you can be. But this one is take the loss and close that out and move on. Our Unilever symmetrical triangle consolidated a bit more from last week and then broke out on Friday. Now we'll see on Monday's trade if we get a follow-through day or not on this, but clean breakout to the upside on Friday. But remember, it means nothing unless it's confirmed with a follow-through day. That would mean Monday's trade would have to close higher as well. This is a great pattern. I really think that this one is going to work extremely well over time. Now, a good way to balance your portfolio from a risk standpoint is if you do want to trade the downside with this downward zigzag that's qualified in the market in general, then run your bullish search. And I'd mentioned to you that over the past week or two, there was a couple times where we didn't have any bullish positions show up in the search, but this week we happen to have a couple that I think bear watching pretty closely. One is AutoZone, and you can see that we're in a wave 3, and we have broken to recent new highs within the wave 3. That's extremely bullish, and a wave 3 in the Elliott wave pattern is obviously the strongest wave. So you come down here and look at the DMI, which is my favorite confirming indicator with Elliott wave, and note that the ADX is very strong, good separation between the two directional indicators. It looks like that one wants to continue. So again, risk management, portfolio management from a risk standpoint. If you're trading the downside in the market in general, maybe you find a couple of positions that are bucking the trend on their own. because it doesn't necessarily mean every single stock. The majority of stocks go down with the market, but not all of them. So you can find those that are going the other way, and we look for Elliott wave bullish patterns with good, solid fundamentals. Another one, and for those of you that prefer the fundamentals, might want to take a look at this, Clorox. And I laugh a little bit because Clorox is certainly not a sexy stock. It's not one you hear about a lot, but it is known as a defensive-minded stock because people use bleach to clean. And the theory is that you're still going to clean your house, you're still going to clean things, restaurants are still going to use it, etc. Even if the economy weakens or the market goes down, etc. Money tends to move into the more defensive-minded things and out of the high beta stuff when things are a little dicey in the market in general. Now the issue here, as you can see, is we've already reached the wave 5 target, and it actually got there a little bit early. But if you've already reached the target, then you want to see, hey, are we going to have an extended wave 5? Otherwise, you'd be nervous that that's it. It did what it's supposed to do. It reached its target price and stay away. So again, looking at the DMI, you can see that the ADX is curling up. There's good separation between the directional indicators. Now, my level for the ADX is 20, and we're not quite there yet. So I would want to see how this one trades on Monday. If that ADX continues higher, breaks above the 20 level, the separation maintains between the two directional indicators, then that would be a signal that we are likely to continue into an extended wave 5 high, and that we would move higher from here. But it is interesting that it's a pretty good pattern that, as you can tell, has definitely been bucking the trend of the market. When you look at the market, that has been going down for over a week, but Clorox has been going up over the same time frame, again telling you money is moving into it as a place to hide money in a defensive name when the market is getting rocky or volatile. So again, I would want to see the ADX break above 20. That's one of my triggers using the DMI, but it does look pretty strong. So again, good portfolio management, trade the downside in the market in general, find a couple really strong stocks that are bucking the trend. That's how you become successful over long periods of time. Not getting greedy, doing smart things, making consistent, reasonable profits, and enjoying the fruits of your labors over time. So that's the report for this week. Hope you've had a wonderful week. We'll be back to talk to you again next week. Take care, everybody.